Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by C5 Plus CCIM Global Summit. It is September 28th to September 30th, and it's in Atlanta, my hometown. It is 3 days of networking, learning, and investing. This is there's a lot of great speakers here. Go to this website and check out the speakers. It's unbelievable. The website is c5summit.realestate. I remembered it for you guys. All right. Welcome to the show. Well, we've got a great show for you today. You know, we hear from economists, we hear from analysts, and we see what's going on. You know, sometimes that's a little delayed, right? What are we seeing today from the front line? Well, today we have one of the biggest developers and ownership groups in the country, especially in the Southeast here. Please welcome my guest, Robert Holder. He's CEO, and Will Menkes, and he's president both of Holder Properties. Gentlemen, thanks for being here.
Thanks for having us.
Thanks for having us, Michael.
And you guys have lots of different sectors and property types. You've got a long history at your company of ownership and properties in office and student and multi and pretty much everything. What sector are you guys really gravitating toward right now where we are today?
Yeah, sure. So, you know, I think we've really spent a lot of time more recently in the office and student housing space. We're exploring a couple other property types that we'll kind of touch on here today, but really the one out of those two is student housing. We spent a lot of time in student housing. We got into it about 15 years ago. We've developed and currently manage a couple thousand beds here in the Southeast. So, you know, it's an area that we've really liked. It's an area that's done exceptionally well over that 15 years. It sort of went from a very niche asset class to a very, you know, established and exciting property type where there's a lot of liquidity going into it. So that's, you know, we're fortunate that we got into it about 15 years ago, and it's done really well for us.
Is it a little bit harder property type to manage than others? I assume it's a little tougher than regular apartments.
Yeah, I think, you know, everybody turns over at the same time, which makes it pretty tough. We've got a very short window of a couple weeks, and, you know, in some cases people want to move in early, so you have even less time than that. But, you know, everybody moves in at the same time. The leasing kind of all happens at the same time, so you don't really get to capture, you know, rental growth like you do in multifamily on a rolling basis. So, you know, the logistics of all that is challenging. Obviously, you know, having kids that are 18 to 22 in your property, in many cases, sort of the first time living on their own, there's maybe a little bit more maintenance that goes into it. But yeah, those are really the primary challenges that we see. It's really just the logistics around moving everybody in and out once per year in a 2-week period.
Yeah. And when I think of Holder Properties, I think mainly new development. So you guys are doing more new development or acquisition of existing properties these days?
Yes, we've spent the last 5 or 6 years really trying to build out our acquisitions business. I think, you know, the development side of the business is great. It's something that we've done. It's pretty much been the primary source of our business for 35 years. But over the last 5 or 6, like I said, we're trying to build out the acquisitions business really as a complement to our development business. I think, you know, we look at every property individually, but really it goes in waves and it's very cyclical. So certain property types will be out of favor and it won't make any sense to develop at certain times, and certain ones will. So, you know, we wanted to have the acquisition business so we don't run into a period of multiple years of just not being able to find anything on the development side that pencils. So now we can kind of play in any type of market environment.
Yeah, that makes sense.
I do think they play off of each other too, in the sense that if you're a great builder, I think, and you know, you have an investment-oriented mindset, you know, you can also be a great buyer, and they inform each other, and you know, you just sort of gain experience in each that really sort of feeds the other one.
Yeah, it makes sense. And you guys are involved in the build to rent as well. How do you like that sector?
Yeah, you know, it's a sector that hit our radar a couple of years ago. Obviously, you read a lot of headlines about it, and you know, it's very much in favor. But you know, we have a couple deals going right now in Charleston, and a bunch more in our pipeline. We find it to be really interesting.
What size are these deals? Acreage or units?
You know, acreage depends, because we'll look at sort of attached townhomes or detached single-family homes. But you know, we're talking between, let's call it 50 and 200 units. So pretty good size.
That's probably one of the biggest challenges of that particular sector. There's a lot of very large groups that want to put a lot of money to work in the single family rental space, and a lot of the sites that we see are 30, 40 units. So you have to be the one to go in and build it and kind of aggregate a handful of these before you really get a lot of interest from the larger players.
Yeah. And we have a group that sells multifamily, and we've helped some folks exit those properties, and they exit as apartments. But as cycles change over time, you guys got a long history in this business. I remember when people did not sell apartments as apartments; they sold them as condos, right? Because they can make more money. On the build to rent opportunities, do you foresee that there would always be just the exit as an investment sale, or might they be sold individually?
Yeah, we look at sites with optionality. We have a couple of those on our books right now, where when we bought the sites a couple of years ago, and we're going through the permitting and entitlement process, we kind of said, well, it could kind of go either way. The housing market here is strong, the rental market here is strong. What would we rather do? Always is a long time, as you said. People sold condos as apartments. Now people sell or apartments as condos. Now they sell them as apartments. I think from our standpoint, what's really changed is the single family housing business has changed a lot over the last, obviously since the GFC, but obviously in the last couple of years as well, or in the last couple of months even as well. Mortgage rates have gone up, by more than double in a lot of cases. And there's sort of a cohort of millennials that are in their 30s and, young 40s that maybe have lived in urban apartments for a long time, and they're starting to settle down maybe later than they did in previous generations, but with mortgage rates above 7% and, down payments what they are, and the resale market for existing homes being as tight as it is, because there are a lot of folks that are locked into 2.5% and 3% mortgages. They have nowhere to go, so they're not going to sell their home. We sort of think that this asset class really brings a solution to people who are settling down, having children, and need a house with a yard, and sort of want to live that part of the American lifestyle. There is also a cohort of people who are on the older end, grandparents and people like that, who maybe want to get out of their house and want to have a lock and leave lifestyle. And so I think we would plan to pursue projects that sort of hit both ends of that barbell.
That makes a lot of sense. And what are you seeing for construction costs and materials and labor these days? Are you seeing that still problematic?
Yeah.
I would say less problematic these days than it has been. I keep asking our development group if costs are coming down. I keep getting laughed at, unfortunately, which is the sad reality. But
not as hard as before.
Not as hard as before. Yeah. But I mean, I think the reality is they're really stabilizing now, and that's a huge positive given where we came from. So it feels like 2 or 3 years really since COVID, it felt like everything that we got a bid on in every budget that we saw, there was a couple of items that were very out of whack. And I think, that's something that it got a lot of press around the lumber pricing going, 4 or 5 times the normal pricing, and steel prices doubling, things like that. But, I think there were kind of constant issues and constant trades that we saw that would be double what their normal, historical averages were. So, now I think it's leveling out. It's probably 30 to 35% above pre-COVID levels. So that's still an 8% annual increase. So construction costs are still elevated, but we're seeing them at least stabilize out. We're not seeing massive month over month increases. Contractors are holding their prices for longer, which was a big issue for a while, where they would give you a price and say this is good for 30 days or less. And now at least they feel confident enough in the volatility dropping down that they're able to say, hold that price for a little bit longer.
Is your expectation that with the higher interest rates, where you mentioned some new development deals aren't penciling out, that maybe construction costs come down? So if you're doing a rezoning today and you're trying to pencil out construction costs, what are you putting for increases on that?
That's why I keep asking. I think that's I think what we're seeing, one of the main things that we look at for construction pricing is the subcontractors backlog. So I think when we look at projects, a lot of the projects that we're looking at now are probably, we're not putting a shovel in the ground for 8 or 9 months. It's pretty far out there in the future, and then it's going to be a 2-year build period. So our kind of view out into the future is 2 to 3 years. A lot of general contractors, we would bring them on before we start that project, so they're looking a couple years out in the future. Subcontractors usually don't have that long of a view. So I think, what we saw in the last couple of years, the peak was the backlog for subcontractors was about 14 months. Now it's about 8, which is still a healthy number. It's still, I would say I'm not sure if it's above average, but it's still, I would say, a healthy number. So, at that point, a lot of subcontractors aren't really feeling pressure to bring their prices down. And, that's really what builds up to the overall construction cost. So right now, like I said, it's leveling out, which is good. I think over the next couple months, we haven't seen a lot of stuff start over the last couple of quarters. I think, a lot of the market data we see supports that. Even areas like industrial that are extremely hot, it was very slow in terms of new starts over the last few quarters. So I would hope that it comes down, but I don't want to make that prediction and be just dead wrong.
But I would say one other thing that we saw, especially in the last couple of years, is we'd start looking at a new project and we'd call subs and GCs that we know really well, or even civil engineers in some cases, and they would say, guys, I'm sorry, we're just too busy to bid on that project right now. We've got too many things going on and all of that. That's calmed down. I mean, now if we make a call to folks we know and like and have done business with before, they'll bid on it for us because they're just not as crazy as they were over the last few years.
Yeah. Well,
we've been getting some phone calls, which, before you were lucky if you got somebody on the phone to answer.
Yeah.
Now it's coming the other way,
some
which is good.
equilibrium in the market.
That's right.
A little bit.
Yeah.
Well, you guys have a long history at Holder in the office world, and I think that's one of the more interesting sectors today with all the changes going on there. You mentioned, new construction leveling off. We're seeing some office buildings get demolished, and we're seeing some get converted to other uses. We're hearing people out there saying, "Oh, demand may pick up in 2024." Then we're hearing folks who are saying, "No, it's going to be years and years and years and years. No one wants office anymore." What do you expect for the future of office?
Yeah, I think you nailed it. I mean, there's a lot of national headlines out there that paint the whole market with a broad brush. And I just don't think I think collectively, we don't think that's particularly helpful. We take sort of the opposite approach. We look at sort of a bottoms up analysis of every building we look at. Because, if you think about it, there's a whole country, and then, there are different regions that have completely different sort of cultural practices around work from home. And then there are different, metros within those regions. So we primarily focus in the Southeast, in the major markets. Even those are a little bit different based on their industry makeup. Then you get down to the, submarkets themselves, and then the building itself. And I think what we have seen, you made a point. There are a lot of, buildings that are being demolished, repurposed, all of those things. But what we think is that there's just going to be a very distinct cut, and it hasn't happened exactly yet, but we're starting to kind of know it when we see it, of winners, buildings that should be office buildings, and I think they're taking the lion's share of the demand currently and will continue to in the future, and losers that are functionally obsolete, that don't really have a place in today's office market, don't really add any value over and above what somebody can get working in their home office. I think the winners are those that provide something that the home office can't. So it's more of a differentiated product situation.
Yeah, it makes a lot of sense. And you're dealing primarily in large Southeast markets, which have been pretty popular and had good growth, right? So do you expect demand to increase for those in those markets overall sooner, later?
I don't know about timing. What I do know
I've got a crystal ball if you need it.
Yeah, well, can I take that home with me? That'd be great. No, I don't know about timing, but what I do know is what's in our portfolio now. Our portfolio has gotten, on the office side, has gotten relatively small. In the last few years, it was much bigger in 16, 17, 18, and just by happenstance, it was sort of time to sell assets over the last few years. But what is in our portfolio now, I think, as sort of COVID raged and the work from home debate was really heating up, and it's obviously still a debate, but we were, at least I will tell you, I was up at night thinking we'd never sign another office lease ever again. And what we have actually found is we've been positively surprised by the leasing velocity that we have seen. We own a building in Charleston on Daniel Island, which is a suburb about 15 minutes away. We bought in 2019 a 2000 vintage or late 90s vintage office building that was the corporate headquarters for a large public company. They moved out. We sort of facilitated that, and then we completely redesigned the building, to sort of 2023 standards. Super amenity base, sort of everything you would want, concierge, hospitality, and we delivered that building, in December of last year, and since then have signed 110,000 feet of leases. In a 180,000 foot building in 9 months, and those are all above our net effective rents that we underwrote. And again, there are good stories and there are bad stories in office. That's why we think that there should be a bottoms up approach, because that's a building that just happens to be winning, but there are others that happen to be losing. And our job when we're buying office buildings, is to really take a really close look at what's going to win in our mind.
Yeah, that makes sense. And
we've had a similar experience. I mean, even in our Peachtree Corners deal that we bought here not that long ago. We've had that for a year and a half now, and we've been able to push rate a little bit, which has been nice, and we moved the needle from about 80% occupancy to the mid 90s. So, I mean, we've seen some positive leasing velocity, like Will said, on the winners, and I feel like our prospect list is probably shorter overall, but if you have one of the buildings that is a winner and you get creative on how to structure deals and make sure you understand what the tenants want, often you can still get some positive leasing velocity in today's environment.
Overall, trend wise, are you seeing tenants asking for shorter leases or smaller square footage than they were using? Or
I think we're definitely seeing both of those things. It really depends on the tenant, but yes, you're right. And I think what becomes challenging about that, and I think the interesting thing is in the office world, what everybody, you read national press, what they're talking about is return to office, return to office, return to office. It's, part of the discussion, but it's not the whole thing. I think when you really start to look at, the fundamentals of the office business, I don't think 100% of, pre-COVID folks are going to return to office. I think the market is, generally, the investment market is generally assuming nobody ever goes back to the office. We're more constructive than that. And we're trying to be, sort of rational optimists in the sector. But I think your point about shorter lease terms and, smaller square footage, what that has done to the office business over the last few years, I think in some ways has been just as profound as, the sort of work from home debate. We used to be able to own an office building, before COVID, sign tenant improvement packages of 30 or 40, bucks a foot, with the tenant investing everything, above that in their space on a long lease. The payback period, just in terms of what they were paying in rent and what we were paying in operating expenses, the payback period is 1 or 2 years. It was a great deal for office landlords. And that was even more true, 10, 15, 20 years ago. Now, those same, tenants come to us, maybe they need smaller square footage or maybe they need a slightly shorter term. But, what we are seeing is they're effectively telling us, we'd love to come to your building. You need to give us a whole lot more in TI. So that $30 or $40 has become $80, and in some cases, I've heard in markets like New York, $200-$300 a foot. But let's focus on where we are. Your payback period becomes 5-6 years, and it becomes a whole lot less attractive. So to us, I think what that means overall is that the office business needs to be repriced in order to sort of generate positive, stable cash flow for owners. What's happened in the last few years is you sign a bunch of leases, you get good cash flow, and then you have to spend a ton of incremental capital to lease the building back up. And that, to us, is probably the most profound issue in the office space.
Yeah, I think that's probably a big part of it, because a lot of people focus on kind of overall occupancy or occupancy of a building and the face rate. And in a lot of cases, we're able to push the face rate. That's not a huge problem. And, if you can get creative, like I said, you can sign the tenants that are out there. But the biggest issue, like Will said, has become kind of the overall cost of building out space. Because when the market gets competitive and somebody wants their perfect space, and ultimately that's going to cost $80 a foot, when we expected a couple of years ago we'd be giving out $30 a foot, that it drops the net effective rent a ton, and it definitely sort of hurts from that perspective. But the headline numbers, the overall rate, and the term, and a lot of times getting the occupancy up, those could look fine, but it's really the TIs are pretty painful.
As you guys are operating these properties and doing new developments, obviously interest rates have increased a lot in the last year and a half or so. How's that impacting your business? What are you seeing out there from your desk?
Yeah, I think, obviously it's impacting everybody. Nobody can hide from the Fed. I wish we could sometimes, but we can't. I think from our desk, what we're seeing is things just aren't penciling quite as, often as they were. Obviously there are issues with banks and being less willing to lend, not, on all property types, just because they're dealing with the fact that loans haven't been paying off at the pace they expected to recycle their capital into new projects. But, overall, I think we read a stat recently that, transaction volume, which isn't, necessarily new developments, but, is down 70 to 80% sort of across all property types year over year, that tells you a lot about sort of what's happening out there. So, we're busy on, a few projects that we've kicked off, in the last 6 to 9 months, and we're very happy about that. But I also think it's going to just kind of take a while for people to, get used to the new reality. And I don't know where rates are going to go. I don't know if Robert does, but
yeah, I mean, I think we've been lucky the last couple of years that we ultimately did hedge most of our interest rate exposure. I think we just kind of took the view that that's not our profession. We shouldn't be predicting interest rates. So why take that into account, or why make that a big driver of the returns of our projects? So, most of our stuff is hedged, but ultimately when we look into the market, it does feel like, office over the last couple of years not over the last couple of years, over the last year, really, year and a half, has been, facing certainly some challenges on the valuation side. But a lot of the other property types that are seeing huge rent growth were really doing fine. The rent growth was kind of outpacing the interest rate rise. So ultimately the values were somewhat flat. But it does feel like recently a lot of the stuff that we're seeing, the guidance pricing is ultimately, the place where it trades is a little bit below, even on some of the sectors that are more popular. So, it does seem like the interest rate piece is starting to really get to a lot of people as rents are kind of flattening out and interest rates are still elevated.
Yeah, good point. We're dealing, representing some tenants who are leasing space and buying buildings, and it's interesting because they have a little more options of properties they can buy, right? And a little bit lower prices and basis. So it seems to be an interesting time. What tips would you give companies and company leaders today about the office market as far as timing or tips for dealing in this market?
I mean, I think the way that we're approaching it is just to be actively in the market. I think, a lot of people just want feedback on what people are thinking of pricing. I think a lot of the brokers are getting a pretty wide range of feedback, quite honestly. And I think, a lot of that in many cases is driving trades not happening at all. But I think, we've just continued to participate in the market, continue to talk to equity groups and people that we would partner with on these to understand, how they're looking at certain deals. Because there is kind of an easy way, I would say, to go about underwriting a lot of the other property types that are a little bit more stable right now. But office, like Will said, I mean, I think we're looking at a lot of buildings that are obvious winners, obvious, I would say, probably losers, and then some in between. And, we have to get pretty creative on how we underwrite those. And I think a lot of the time we're ultimately looking at it like, if we were to buy this, let's not assume we can just fix it up and exit in 3 years. Let's just assume we're going to hold this for a long period of time. And what does that look like on a long-term basis, and finding partners that are comfortable with that kind of capital. So, that's how we're looking at it. But I think everybody's looking at it differently, and that's what's resulting in a lot of the bids for these office buildings coming in a very wide range.
Are you doing or looking at any potential conversions of office to other uses?
We have, we have looked at some, that's obviously a very hot topic right now. And a lot of CBDs, or central business districts are really hoping that works. I think what we have found is it's really a sniper shot on which ones work. What we are seeing more of, frankly, is buildings that are being demolished, like the point you earlier made. I think the conversion requires a very specific footprint, requires very specific building depths, so that, the units aren't so deep that, you could be at your front door and not see a window for, a very long time.
Bowling alley.
Yeah. You could live in a bowling alley, but we are seeing them, and I know that some of the really kind of smart global architecture firms have started to really almost systematize, how they score whether or not a building will work for a conversion. But what we are seeing more of is the sort of obsolete buildings on the office side that, may be on 10 acres, in a good, high quality suburb, trading to be demolished to become something else. Townhomes, multifamily, whatever, retail, in some cases.
Right. Well, you guys do medical office, and that's sort of an obvious transition for the office buildings that makes sense, that are near some of these medical nodes. I mean, medical office continues to be very popular, and, based on sort of the size of a building and where it's located, that's a much easier conversion. But like Will said, the residential ones, it's just so specific to the individual building and the floor plate to make sure you're not creating some very funky units. But I think we've looked at it in a number of different ways. Some of the pricing that we've seen on office buildings, we looked at office to self-storage conversion at some point in time in the past, which didn't work out.
just didn't pencil out, right?
Yeah.
Yeah. That's interesting. Well, let's finish the show. Get your view on industrial real estate. What do you see for the future there?
Yeah. So industrial is a space we like a lot. We've spent a lot of time on it, in the last couple of years. I think, our view is that in the medium and long term, there are drivers that are going to give it really kind of strong, steady demand growth over a long period of time. Maybe, across the country, but, we focus primarily on the Southeast. What you're seeing is the ports in the Southeast growing exponentially and really working to expand and improve their ports. So that's, Charleston and Savannah. We see reshoring of, sort of manufacturing and the supply chain after the post-COVID craziness and maybe some of the geopolitics with China. We're starting to see that happen in Georgia, for example, with all the new EV and battery, manufacturing plants that are popping up. And then the third is, maybe the most obvious one, but it's just sort of the rise and growth of e-commerce. So those are very big tailwinds that we think will continue over time. That said, the last couple of years during COVID were wild. The amount of space that was delivered, the amount of leasing that occurred, the amount of rent growth that occurred, it was a bonanza. And so I think what we will see is a slowdown, for a period of time, but ultimately the demand will catch up, and that's where we hope to be to fill it. I think a good example is in Atlanta, which is the fourth largest industrial market in the country. There were no starts in Q2. I think Robert may have already said that. That was unthinkable, a year ago. But because the build period on those kinds of projects are, much shorter than a multifamily tower or an office tower or whatever, you may see some supply start to come back and capture, those demand drivers.
Yeah. I mean, it's nice that being in the Southeast, the rents here are notably lower than a lot of other places in the country. So a lot of these national groups that are looking to lease, when they see the rates in the Southeast, even if we moved them from $8 to $9, which seems like a huge increase to them, $9 sounds great. So I think, being in the Southeast with all the port growth and everything else has been a huge driver. And then just the lower cost down here is actually very helpful for that area too. But like Will said, there's been a lot of supply, but the supply, I think, is moving the needle from 97% or some, crazy occupancy number down to maybe 94 at worst. So it's still a very healthy market, even once you take that supply into account. So, construction slowing down and demand still accelerating. It's definitely an area we want to be in.
All right. Well, good points, gentlemen. Thanks for being on the show. Great information.
Thank you very much, Michael.
Yeah.
Appreciate it.
And thank you for joining us around the country. Please let us know what you think. Please share the show. Hey, and reach out to us if you have any questions or ideas. You can reach me directly. My email is michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. By C5 CCIM Summit, 3 days of commercial real estate networking, learning, and investing. Learn more and register at c5summit.realestate. And by Lument. For senior housing, healthcare, and multifamily financing, visit lument.com. For more podcasts and videos, subscribe and visit creshow.com.